Good afternoon. Welcome to Mid-Cap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me today is Ekta Batra. Some recovery from the lows. It's been choppy so far. But yes, we are sitting with gains of 35 points right now. And Bank Nifty and mid-caps, they are outperforming.
Hi, Sonal. Yes, absolutely. But the story really lies underneath the surface at this point in time, with the IT stocks really taking the brunt in today's trading session. All that and more in the next 30-odd minutes. These are top stories. Stocks swing between gains and losses as IT drags, but the real economy plays. Energy, utilities, consumer durables and metals offset the impact. In fact, advances far outstrip declines, keeping the positive sentiment intact.
Hindustan Aeronautics, previously a front-runner to build India's fifth-generation stealth fighter, has been reportedly knocked out of the race. The stock slipped 6%.
Nomura upgrades XI to a buy rating with a target of 398, expecting the industrial business to recover even as growth in the auto segment remains healthy.
And shares of Lloyds Metals, V2 Retail and Sheela Foam, they see gains in today's session on the back of solid December quarter numbers. V2 Retail, though, has come off from the highs.
All right, so those were all of the stocks that we are following in today's trading session, all of the top stories that we're tracking at this point in time. Remember that the broader markets are seeing some amount of momentum or a marginal amount of outperformance at this point. So the mid-cap index is up around 0.3%. The advanced decline ratio stands in positive terrain as well. Remember that yesterday was that super performance for the markets reacting to the India-US trade deal. So today is a little bit of consolidation which is taking place. However, the advanced decline ratio, like I mentioned, is on the positive side. So 2,700 stocks advancing to around 1,600 stocks declining at this point. Maybe we can just go across to Gaurav now if he is with us. Yeah, to take us through all of the mid-caps that are moving around in trade this afternoon. Gaurav, over to you.
Well, as if you look at the mid-cap index, it is actually up 0.3%, and the reason being that it looks like the US tariff trade euphoria is still not over, because we have got stocks like Gogoldas Exports, Sheela Foam, Kitex, Avanti Feeds. All of these are actually up in trade. And on the flip side, if we look at the IT index, now that is seeing some kind of pressure, and the reason being that the Anthropic AI tool, which is actually taking over the IT index, not just in India, but we saw this effect in US market as well. We've got Eclus, Signity Tech, Coforge, LTIMindtree, Persistent System, all under pressure. Remember today from the Nifty mid-cap index, we saw Oil India actually reaching its 52-week high. But on the flip side, we saw IT names like KPIT Tech reaching its 52-week low level. So all in all, it looks like on one side, we are seeing sharp gains, but on the other side, which is IT, we are seeing some kind of cuts coming up from the market in a day-to-day.
Okay, all right, take that point. Thank you so much, Gaurav, for joining in. Let's get stock specific now. Pidilite posted a good and a consistent quarter in terms of volume growth and even margins. My colleague Mangda Malu caught up with Sudhanshu Watts, the managing director of the company, began by asking him as to what could have been better in the quarter and also if there are any downside risks going forward. Listen into that conversation.
What could have been better is that in the quarter that has gone by, I think we also faced a little bit of pressure because of the US tariff. You know, there is a part of our business which has basically a high export intensity. And I think that business got affected in quarter three. So we've delivered a 10.2% growth, but Mangalam, that number could have been upwards of or closer to about 12%, if I could say so.
All right, but,
but
between that,
consistently delivering, building on the portfolio, I think that's very good.
between that and now, you know, the US-India FTA has been, or rather a trade deal has been signed. So do you think this removes the uncertainty and that 10% becomes 12% starting next couple of quarters?
We will continuously lift the growth, Mangalam. It's difficult to predict and give a specific number, but I think we will continue to lift our growth. You've seen that even if you look at 9 months into this year, Mangalam, our growth has gone up by about almost a percentage point. And I think that's something which we will continue to grow as we go forward.
And what about the domestic business? What do you make of the environment right now? Because a lot of the other building products peers, they did say that, you know, there was this shorter festive season, extended winters, or rather extended monsoons, all those factors impacted their volume growth. And you did near 10% volume growth in that as well. What do you do differently and how much of this is likely to continue?
So, Mangalam, I think one thing which I have steadily maintained in all my conversations with you is that what comes into play when it comes to Pidilite is two things really stand out. And I think something which we continuously keep working on. And, you know, one is the strength of our portfolio. So we keep building our portfolio, Mangalam, which allow us to sort of, manage some of these external factors better than most of our peers. And I think the second thing which is interesting about us is our execution machinery. So we continue to sharpen the pencil as we keep going, and we are obsessed about improving ourselves and getting better of ourselves when it comes to execution. So these two things give me a lot of confidence. If you look at the quarter that went by, for us, our construction chemicals portfolio, particularly Roff, which is our tile adhesive brand, and also Dr. Fixit, were our star performers in terms of growth. Other brands also did well, but I think these two sort of lifted. So what happens is, quarter to quarter, year to year, you will have one star batsman who will come and score a century, Mangalam. And that ensures that you always put a good score on the board. I think that's the way we work.
You often say this, that you have this core growth and pioneer categories that happened, etc. If you could give us a sense, because you don't give us specific portfolio numbers, what proportion of your portfolio grew 2x, 3x of the overall growth, and which of these underperformed the domestic business?
Yeah, in the domestic business, if you look at it, I think the businesses that continue to do very well for us is, like I talked to you about construction chemical. This part of the business delivered between 2x to 4x, depending on the brand which you were looking at. I think in terms of our core portfolio, we actually delivered good numbers, but we delivered closer to 1x this time. So ideally, our desire is to keep that between 1 to 2x. I think the core part of the portfolio also delivered, but delivered more between 1 to 1.2x of the GDP. So I think that's the way it has been. I think most brands came in and delivered. The growth was outperformed by some of these, and also our projects business. So if you look at projects, we continue to do very well. There again, we've delivered upwards of 20% growth. I think that's what has happened.
Proportion of your revenue is from projects? Because, going forward, the kind of buildings that are coming by, the projects that are being announced, etc., from the real estate players, etc., how much could that impact your growth going forward?
So as we continue to grow, the ratio of projects in our portfolio, or share of business of projects in our portfolio, will keep growing, Mangalam. We don't share a specific number, but all I can tell you, it's sizable, it's continuing to grow. And as it grows further, the share of business will grow. And with that growth, that will continuously give us a lift on our overall growth as we go forward, particularly in domestic business.
And you're not worried about the recent commentary coming in from real estate players where, they perhaps overestimated demand, and as a result of which they're not able to meet their near-term guidances. Is that a concern for you?
So, Mangalam, what happens in our case is that first, I think even if you look at real estate, and even if you look at new construction, you can cut it in multiple ways. There is an element of real estate which is not affected at all. As you know, I think we are sitting in South Bombay at this moment. So there are some which are doing exceedingly well. But fortunately for us, in our portfolio, there is both new construction, but there is considerable renovation and repair. And I think the combination of two, and I think that sort of again insulates us.
How much is that mix, renovation versus new construction?
So I would say renovation at around 70 to 75%, and new construction between 25 odd percent. So 25, maybe 25, 30, keeps sort of moving around. So that's the mix. So for us, renovation and repair continues to be higher than new construction.
All right. What do you say about the raw materials? Because it's been fairly well behaved over the last 12 to 18 months, if I remember, VAM prices. Right now, the currency has been a bit of a concern. Do you think that could veer you away from your margin band right now?
So no, we've maintained a margin band of 20 to 24%, Mangalam. I think as far as VAM is concerned, VAM has been quite benign and steady for quite some time. I think in the quarter that's gone by, it was at about $840. I think we feel that it has perhaps bottomed out. But having said that, I think the impact of rupee depreciation or a little bit upward movement on VAM is something that can be absorbed by us, or even can be transmitted in the form of price increase. So as far as margin is concerned, between our ability to pass on the price increase and also some of our cost effectiveness programs, at this moment, we are not worried at all.
Your band is fairly broad, 20 to 24% is nearly 400 basis points. The question was more towards whether it stays around this 24% band where it has really been over the last few quarters. So, or is there any downside risk for it to go to even 21, 22%?
See, Mangalam, as you know, quarter on quarter it fluctuates. But as far as the year is concerned, I think the year that is going on, 9 months into the year, we are at around 24%, actually marginally ahead of 24%. I think in the foreseeable future, with the way the raw material pricing is, we see ourselves at the higher end of the band.
All right, so 10% volume growth continues, 20 to 24% EBITDA margins continue. Just a final question before we let you go. Domestic versus, rather consumer versus B2B. B2B had underperformed because of the exports factor that you said. Will the mix of this volume growth, 10%, be led by consumer or B2B in the next few quarters?
So, Mangalam, I think once also if we break up the B2B for the quarter that has gone by, domestic B2B business has delivered mid-teens growth. So I think, so therefore that's a good news. So therefore that gives us confidence. As far as we are concerned, we would like both engines to fire. So for us, consumer and bazaar should deliver double-digit growth, but I'm quite confident that B2B also will come back total now, I think, with the improvement in environment into strong double-digit.
Okay, so that's the management of Pidilite. That stock is up around 1.5%. We also had the MCure numbers which came out, so that stock should come up for you as well. MCure is the one that I'm talking about, up around 1.5%, with revenue up around 20% this quarter. So good going in terms of a performance. We'll take a short break on that note, but we'll get you a lot more on the markets. A lot of stocks in focus this afternoon. All that and more on the other side. Stay tuned.
Welcome back. There's a definite recovery which is underway. We'll have to see whether this sustains or not. But in the broader markets, we are seeing some pressure on specific stocks. HAL is one of them. There is some project that has been taken away from them and it could impact their profitability. Ria is here to tell us more. Ria.
Well, yes, HAL has been knocked out of the race to develop India's fifth generation stealth fighter jet, or the AMCA jet program. Now, this is as per industry reports that have been confirmed by analysts, and HAL was expected to be the front runner for this up until now, which is why the street is reacting so negatively to this new development. HAL had bid for this program with two other smaller firms, and this will now be the first time that HAL will not be involved in one of the country's most significant military projects. The other bidders for this project include Tata Advanced Systems, Adani Defence, L&T and Bharat Electronics, as well as Bharat Forge in partnership with BEML and Data Patterns, among some other companies. And as per reports, three of these companies have now been shortlisted, and the final project winner is expected to be disclosed within the next 3 months. The AMCA project as a whole, the total development cost for the prototype has been valued at 15,000 crores initially, and the total project cost is valued at roughly 1.5 to 2 lakh crores. So this will be a very significant project, and in terms of the impact on HAL, analysts believe that this will be sentimentally negative for the stock, and they do not expect any material impact on the financials of the company. Keep in mind that the FY25 order book of the company stood at roughly 1.9 lakh crore rupees, and at the end of FY26 they are expected to have a closing order book of roughly 2.5 to 2.6 lakh crores. So they already do have a very strong order book that provides them revenue visibility for the next few years. But nonetheless, the stock today is taking a hit, down roughly 6% in trade.
Okay, all right. Thank you so much, Ria, for that. So that is on the back of a news update, but earnings, they're coming thick and fast. Mankind Pharma is on our radar. Ekta, how did the numbers look?
Well, largely the numbers were in line, but the street probably is a bit cautious on the stock. So the revenue was up around 11.5% this quarter, but it was down 4% on a Q-on-Q basis. Similarly, the margins came in at around 25.8%, which was largely in line. And we had the profit, which was up around 12% on a year-on-year basis, but declined 18% Q-on-Q. The domestic business was up 11% year-on-year, which is the bulk of the business, but it was down 4.3% Q-on-Q. Consumer health, which is a part of the domestic business, was up 5%, but was down 10% sequentially. Exports was up 14%, but was down and was up only around 1.6% on a sequential basis. So that's probably one of the reasons why the street was a bit cautious on Mankind Pharma's numbers this quarter. We do have the Century Ply numbers on your screen, where the operational performance definitely looks better. We'll take a short break on that note, but more on the markets once we're back. Stay tuned. Welcome back. Well, for the market, seeing a marginal amount of movement coming in for the mid-cap, so up around 0.4%, with the Bank Nifty up around 0.4% as well. But let's talk about certain stocks which are in focus, and we do have a couple of them which are buzzing around. We have Nigel as well as Rima joining in to tell us about the stocks that they're tracking this afternoon. Well, Nigel, let's go across to you first. Lloyd's Metal is the one that you're looking at.
Well, Lloyd's Metal has corrected close to around 20% from the recent peak, but the numbers look very, very good. The reason that I say that is that the EBITDA number came in at around 1,800 crores. And the reason that it's good is because in a single quarter now, they're doing 1,800 crores of EBITDA. In FY24, they did close to around 1,750 to around 1,800 crores of EBITDA in the full year. And last year, if you compare quarter three's EBITDA number that they have delivered in comparison to FY25's total EBITDA, actually they've achieved close to around 90% of that EBITDA. So the run rate clearly has gone up from a few hundred crores to around 1,800 crores on a quarterly run rate, and the margin's improving by around 35%. How do they manage this? They've got EC limit that's been increased, so they are, mining a lot more iron ore and obviously selling a lot more. The pellet production as well is moving up, but the sponge iron production as well is moving up. So put all that together, operating leverages play out. They've done various other measures with regard to the operational efficiency, which is helping them on the margin front, and value-added products as the percentage of their mix as well is moving up. So that explains why the past quarter is very good. Now the guidance is very strong. For example, on iron ore production, they'll do 22 million tons odd, but for the next year, it'll be 25 to around 26 million tons. On the pellets front, they'll do close to around 6 million tons to around 8 million tons of production in the next year. And also, from being, just a pellet as well as an iron ore miner, now they're going to become a steel company. And part of that will be seen in the next fiscal itself. The management spoke to us here on CNBC-TV18 and we quizzed them. Going by the EBITDA per ton that they're doing and going by the volume guidance, they could potentially do close to around 7,500 crores of EBITDA just from the iron ore business as well as the pellet business. They go on to confirm that the Triveni engineering business could do 2,800 crores to around 3,000 crores of EBITDA, and the copper business could pull up 500 to around 700 crores. So from a company that's doing around 1,800 crores of EBITDA on a quarterly run rate, in the coming year, they could potentially do 10 to around 11,000 crores of EBITDA in the entire fiscal. Explains why the stock is excited. Back to you guys.
All right. Thank you so much for explaining that. 10% higher on that name today. But Exide Industries, that's the other one on our radar. Nomura has upgraded the stock. Rima, tell us more.
Yes, so Nomura has upgraded the stock. They say Q3 numbers are largely in line with expectation. The auto segment remains healthy. Industrial business is likely to recover. But what they go on to argue is that the stock has underperformed the market. So in the last 6 months, it's down 20%, while the market itself is down close to about 3%. So after that, the core valuations of the company stand at 10 times FY28. Core is X of the lithium ion cell investment and even the investment, the stake that the company has in HDFC Life. About 3 months back, this core valuation was close to about 13 times. So Nomura argues that now, after the recent underperformance, the valuation looks attractive. The company is expected to see an EPS growth of 17% and hence an upgrade from a neutral rating to a buy. The target price stands at 398. Back to you.
Okay, all right, Rima as well as Nigel. Thanks very much for that. So that's the update that we have on specific stocks, and that's all the time that we have on Mid Cap Radar. Your stocks once we're back. Stay tuned.